welcome to the deep dive. Okay, today we're skipping past the usual high-level stuff, the CEO remarks, and diving straight into, well, the financial engine room.
Exactly. We're looking directly at the CFO's opening comments for Q3 2025. That's where you often find the real story about strategy and money.
Right, because the CFO, Wayne DeVate here, he's the one talking hard numbers, capital allocation, where the actual bets are being placed for the future, not just messaging.
Mm-hmm. And he laid it out clearly. He started with a thanks to the team, which is standard, but then, boom, focus on three things: quarterly results, capital structure, and the outlook for 2026.
So our mission today is pretty straightforward. Unpack those three areas for his perspective. We want to get at the why behind the numbers, understand how they're balancing today's performance with these big future investments.
Yeah, understand the trade-offs, like why invest heavily internally right now? What does that signal?
Let's jump into Q3 first then, because the basic numbers, they look pretty solid, don't they?
They do. It suggests the underlying business is strong enough to actually support these bigger strategic moves they're making.
Okay, so top line result, adjusted earnings per share, $2.92. That was just slightly ahead of what analysts expected.
Yep, a small beat. And revenues, huge. Over $113 billion. That's up 12% compared to last year. Pretty healthy growth.
And where's that coming from? Membership seems key.
Definitely. He highlighted total domestic membership cracking 50 million. And year to date, they've added, what was it, over 780,000 domestic members. So they're still pulling people in.
Okay, now the ratios. This is where it gets interesting. Medical care ratio, MCR. That's how much premium money goes to actual medical care. It came in at 89.9%.
Yeah, and compare that to 85.2% last year in Q3. That's a noticeable jump. It reflects those higher healthcare usage trends we've been hearing about everywhere.
But the CFO seemed not panicked about it.
Well, that's the interesting part. He framed it by saying that even with that 89.9%, the medical cost trends are, quote, consistent with their 2025 outlook.
Meaning they expected this level of cost.
Or at least they believe they've accounted for it in their pricing for next year, for 2026. They're saying, we saw this coming, we priced for it. It's a confident stance.
Okay, a big bet on their forecasting and pricing power then. What about the other side? The cost of running the business, the operating cost ratio, OCR?
That hit 13.5%. And this one also increased. But unlike the MCR maybe, this was seemingly more deliberate.
Deliberate how?
This is where you see the strategy in action. DeVate explicitly said the higher OCR reflects larger investments in technology and people than originally contemplated. They chose to spend more operationally.
Right. Okay, so they're accepting higher running costs now for some future benefit. Did he say how much?
He did give a number, over $450 million, and it went into two main buckets. Broad-based employee incentives, so investing in their own people and contributions to the UnitedHealth Foundation.
$450 million is a serious chunk of change. That could have gone to buybacks or dividends.
Exactly, but they directed it inwards. And significantly, he noted, it was proportionally more weighted towards Optum Health and Optum Insight.
Ah, so pinpointing the investment. Optum Health is the care delivery side, clinics, doctors.
Right. And Optum Insight is the tech and data powerhouse. They're pushing hard on AI applications there too, apparently.
So the signal is future growth comes from better care delivery, powered by much smarter tech and data, and they need the people to make it happen.
That seems to be the bet. It suggests they see tech integration and, frankly, keeping their skilled workforce happy as critical competitive ground.
Got it. And quickly, did he touch on cash flow? Did all this spending hurt their liquidity?
He mentioned strong cash flows, actually, 2.3 times net income. And their days claims payable, that increased slightly by 1.7 days from the previous quarter.
Okay, days claims payable, basically how long they hold on to cash before paying claims. So a slight increase means they're managing cash efficiently.
Yeah, it's a sign of solid liquidity management. They're holding cash a touch longer, even after that big $450 million investment. And don't forget the Amedis deal closing.
Oh, right, we'll get to that.
Yeah, even with all that, they expect year-end operating cash flow around $16 billion. So they're liquid.
Which, as you said, sets them up for the next piece, managing their capital and debt.
And DeVate was very direct here. He stated they've basically hit pause on big strategic acquisitions and also on share buybacks for now.
A self-imposed pause, you said. Not forced by weak results.
Seems proactive, yes. It's about tidying up the balance sheet after a lot of M&A activity like Amedis.
And is there a specific target for this tidying up?
Yep. Get the long-term debt-to-capital ratio back down to around 40%. And also get their interest coverage ratios back to historically comfortable levels.
Why is 40% the magic number for debt to capital?
It's generally seen as a healthy level for a company like this. It maintains strong credit ratings, which means if they do want to borrow big again later, it's cheaper. It's about preserving financial firepower, financial flexibility for the future.
So sacrificing immediate shareholder returns like buybacks to ensure long-term financial strength and options. Where is the ratio now?
It's currently at 44.1%, which actually is pretty stable considering.
Considering the Amedisys deal closed in Q3, how much cash did that involve?
That was a net cash outlay of $3.4 billion. So yeah, absorbing that and keeping the ratio relatively stable at 44.1% is quite something.
And let's just quickly connect Amedisys to the strategy again. That wasn't just buying something random, right?
No, Amedisys is big in home health care. It fits directly into Optum Health's strategy of providing more care outside of expensive hospitals. It's vertical integration. So they made a huge strategic buy.
For $3.4 billion.
And now they're hitting the brakes on other external stuff specifically to pay down the debt they took on for it relatively quickly.
Makes sense. Did he give a timeline for getting back to that 40% target?
He did. He anticipates the ratio getting closer to 40% in the second half of 2026.
Okay, so this pause on buybacks and major M&A isn't forever, but it's likely for, what, the next year or so?
Pretty much through most of 2026, yeah. He explicitly said they expect to be in a position to restart those things, buybacks, strategic deals, later in 2026.
So the sequence is clear. Buy the strategic asset, digest it, fund the internal tech and people engines we talked about, pay down the debt, then tune the external growth, and buyback taps back on.
Exactly. It paints 2026 as a year of, let's say, internal execution and balance sheet discipline, rather than flashy external moves.
Right. Which sets up the outlook for 2026 perfectly. You said he framed it as a setup year for stronger growth later.
Yeah, his words were about accelerating returns in 2026 to position for meaningfully stronger growth in 2027 and beyond. He also said, while formal guidance is coming in January, he's comfortable with current consensus.
Okay, so the market's expectations for 2026 are probably in the right ballpark, but it's not going to be an easy ride.
He talked about headwinds, didn't he?
Oh, yeah. Big ones. Top of the list, the final year of V28. That's the Medicare Advantage rate and risk adjustment pressure. He put a number on it. A $6 billion plus headwind.
Wow, $6 billion. That's a massive drag on the enterprise. How do they plan to counter that? Through actions around benefit design and cost control. They believe these operational levers will substantially offset that $6 billion impact.
Substantially offset still sounds like a huge challenge. That's a lot of pressure on making plans more efficient or maybe less generous without losing members.
It absolutely is. And it's not the only pressure. Remember those investments we talked about?
$450 million in tech, AI people.
Well, that continues. Further investment is needed in Optum Health and Optum Insight. So that's another ongoing cost pressure, a necessary headwind, if you like, because it fuels the future growth.
Okay, so regulatory pressure, continued investment spending. What else?
Two more structural things. First, taxes. The effective tax rate is likely going back to a more normalized level in 2026. So no more tailwind from unusually low taxes like maybe in 2025.
Okay.
And second, interest rates. As rates potentially decline, the income they earn on their investments, their treasury income, is expected to go down too. Less free money from interest.
So V28, ongoing Optum investment, higher taxes, lower investment income. That's quite a list of challenges for 2026.
It is. But then there are the tailwinds, the things working in their favor.
All right, let's hear the good news. What's going to drive growth or offset those headwinds?
The number one thing is pricing. He emphasized repricing efforts, especially in the commercial and Medicare plans. This is where they plan to really push earnings growth back towards their long-term target margins.
So connecting back to that MCR discussion, they're confident their new pricing accurately reflects the higher medical costs.
That's the bet. They believe the pricing actions taken for 2026 will stick and will align better with the actual cost trends.
Okay, what else?
Stability and measured growth from the Optum businesses. Remember, Optum Health and Optum Insight got that big investment boost.
Right. But didn't you say some of that Optum growth gets reinvested?
Yes, and the CFO was careful to point that out. It might slow Optum's reported growth in 2026, but that reinvestment is precisely what's supposed to power faster growth in 2027 and beyond. It's that foundation building again.
Makes sense. Anything else on the tailwind side?
Well, the debt paydown we discussed. Paying down debt directly reduces interest expense, which helps the bottom line, especially if rates are indeed falling.
So the debt discipline becomes a positive contributor.
Exactly. And finally, he mentioned taking aggressive steps on affordability initiatives, which is basically trying to manage the underlying medical cost trend itself, trying to keep it below the rate increases they're putting through. It's about managing the core cost drivers.
So it really does sound like 2026 is this intense balancing act, fighting off that huge V28 headwind, continuing to spend big internally, paying down debt, all while trying to get pricing right and control costs. It's execution focused. Hashtag tag tag outro.
Absolutely. It's a complex picture with, as Devate put it, many moving parts, but the message was one of confidence. They feel they have concrete plans to manage these pressures and deliver the kind of performance that sets up stronger future growth. It's very much a transitional year.
So the key takeaway for you listening is probably this. Don't expect fireworks in 2026 perhaps, but look closely. It's a year defined by strategic patience, internal investment, and getting the financial house in perfect order. It's all about laying the groundwork for a potentially much more powerful 2027.
It brings us right back to that core strategic choice they made.
That's right. Think about that decision. Prioritize over $450 million for internal capacity, their people, their tech, especially AI, rather than using that cash immediately for something like share buybacks.
It's a significant bet.
It really is. So the final thought for you is, what does this massive strategic wager on building up internal capabilities, particularly advanced tech and AI, tell us about what competition might look like and cost in the healthcare services market over the next few years? And who really stands to gain the most from this kind of heavy upfront investment?